Okay, guys, we are back today with another book review, book report. Again, these videos are for me to give you the gems from the book. Since I read the book, use me as your cliff notes. I'm going to go through the book, just finished reading the book. I'm going to take all the leverageables, all the takeaways, all the key information that I learned from the book. I'm going to give it to you so it can make your trading journey a lot easier. It can make you get to your profits better, faster, and have new understandings and insights when it comes to your trading and your investment strategies. And so today's book is Statistical Arbitrage, Algorithmic Trading Insights and Techniques, written by Andrew Pole. So again, I've already read the book. I'm going through this. I'm just going to give you a book review so you can move forward with your trading journey and get into your trading faster. Okay, so I've got the book open on my computer. Let's see here. Just scrolling through it. Statistical arbitrage, introductions, a couple processes, structural models, law of reversion. Gauss is not the god of reversion, interstock volatility, quantifying reversion opportunities, noble difficulties, Trinity troubles, arise black boxes, statistical arbitrage rising. Okay. So a lot of this arbitrage started at Morgan Stanley in the 1980s. Let's see. This is the how-to manual. Maintaining a model's utility is one theme of the book. Just skip over the introduction. Go into the foreword. Statistical arbitrage is generally regarded as an opaque investment discipline. Statistical arbitrage exploits mathematical models to generate returns from systematic movements in security prices. A lot of managers don't want to disclose their strategy, so they'll talk in generalities that are only understandable by the mathematically trained. Statistical arbitrage fills that void. It's been in investment for 25 years. Let's see. Some acknowledgements. Gregory Van Kipnis. We are always ready to learn from repeatable occurrences, however odd they may look at first. Box on quality and design, GEP box. So they would buy and sell stocks in pair combinations at Morgan Stanley's black box. Pairs trading. Find a pair of stocks that exhibit similar historical price behavior. When the prices of the stocks diverge, bet on subsequent convergence. Blindingly, beautifully simple, and hugely profitable. Let's see. For example, there's two airline stocks. Notice the spread. Buy the lower price stock and short the higher price stock when the spread is wide. And reverse out those positions when the spread closes. 1985, computers weren't regular appliances in homes. The SEC was intrigued. The stock exchange in the 80s was populated with over 50 independent specialists. Early years were enormously lucrative, spawned several independent practitioners. 2 decades later, the adult statistical arbitrage that grew up from the pair trading infant faces a cataclysmic environmental change. returns have greatly diminished. Says here, Ice Age dawned in 2000, entered full frigidity 2004. Rise and fall and rise again. Let's see here. Much of what happens can conveniently be thought of as random variation, but sometimes hidden within the variation are important signals that could warn us of problems or alert us to opportunities. Box on Quality and Discovery, GEP Box. As the analysis techniques became more sophisticated, models deployed became more technical, so the sobriquet by which the discipline became known was elaborated. The term statistical arbitrage was first used in the early 1990s. Noise models. The first rules defined for trading pairs were plain mathematical expressions of the description of the visual appearance of the spread. Reverse bets. Why not bet on that movement? Unwind the bet when the spread is 0. With the reversal, reversed along the short positions. Now position was always held, waiting on the spread to increase from low value or to decline from a high value. With that expansion of trading opportunities came more trades and greater profits for no additional work. Multiple bets. Spread varies over a $6 range from a high of $7 to a low of $1. Doubled bets on the spread shrinkage would be made both in 2002 and 2003, increasing profit by 150%. Rule calibration. Calibration epochs. The question of how much price history to use to calibrate a trading rule is critical. 4-year spread is used. Upper and lower limits, maximum negative 20% range and a minimum plus 20% range. Within these limits are at times not nearly as good as the eyeball limits previously examined. Both winning and losing trades exhibit periods where substantial mark-to-market losses are incurred before gains accrue toward the end of the trade. If a spread experiences a quiet period, business will be poor because few opportunities will be identified, even though there may be plenty of profitable opportunities. Better to be conservative and use a large margin. Popcorn process. Spread will systematically vary from substantially above the mean to substantially below the mean and so forth. The sine wave is the archetype. The equation for the popcorn equation. When the spread increases or decreases sufficiently far from the mean, say K standard deviation, sell or buy the spread. Unwind the positions when the spread returns to the mean. Identifying pairs. Which pairs grouped by broad industry classification, and every pair within those groups was a candidate. Risk management was rudimentary. Event analysis, the turning point algorithm works as follows. Local maximum in the price series is a turning of subsequently. The price series declines by an amount giving a negative return greater in absolute value than a specified fraction of the localized end. Return volatility. It goes on to list the 5 steps. Similarly, local price minimum is a turning point. Look at the price trace in figure 2.6, referencing a graph where it gives some more equations. Window of 20 days to define local volatility. Then have some graphs here. Adjusted close price, General Motors within a 30% turning points identified with 30% turning points. They provide returns of about -4%, a fabulous annualized rate of return. Correlation search in the 21st century. Several vendors now offer software tools for managing aspects of pairs trading, portfolio configuration and risk control. Some modelers incorporated risk exposure calculations along with return forecasts into the portfolio construction process. Maximizes return employed capital in portfolio selection. Forecasts, unlike foresight, do not come with the guarantee of the outcome. The risk is acting on forecasts. Go for the best becomes go for the best guess, but bear in mind what disasters might occur and do your best to protect against those undesirable outcomes. Maximize expected return subject to a limit on believed variation about that expected return. Several factors: number of stocks in investment universe, expected forecast return for stock, expected variance of returns, value to be invested in stock, risk tolerance factors, exposure to market factors, market impact, market impact is incurred with most trades, regardless of size, since the market is not static between the time of a forecast is made and the time the desired trade is placed and subsequently filled. Risk control using event correlations. Dynamics and calibration, local data, techniques of evolutionary operation can be employed to help uncover persistent changes in the nature of the reversion phenomenon exploited by a model. Evolutionary output, single parameter illustration. When selecting a parameter value at which to operate a strategy, it is critical to understand both the form of the response curve and the natural amount of variation, and relate these to the understanding of the phenomenon under study when it is available. Excuse me. Years are somewhat artificial and arbitrary time periods in this monitoring context. Private information is practically the source of every large modern fortune. An Ideal Husband, Oscar Wilde. Formal forecast function. The value of thinking about a formal forecast function is that it gives a specific set of values to compare to realizations and thereby to judge the efficacy of model projections. Exponentially weighted moving average. The EWMA scheme applies exponentially declining weights to the entire data history. The recursive form of the EWMA forecast calculation immediately reveals a simplification over MA schemes. Empirical experimentation is a sounder approach to developing understanding than blind assumption of normality, and a good place from which to build a representative formal model if that is your goal. Autoregulation and co-integration. Dynamic linear model, volatility modeling, pattern finding techniques, fractal analysis, a factor model. So-called factors minimize the discrepancy between observations and model-fitted values. Defactored returns, operational construction of defactored returns, prediction models, stochastic resonance, practical matters, doubling a deeper perspective. The J-curve of initial loss followed by recovery of gain. Figure 3.9 shows the archetypal tree of trade cumulative return trajectories. A, gain from the trade inception to unwinding. B, loss from inception to trade cancellation. C, the J-curve of initial loss followed by recovery and gain. Factor analysis primer, some more equations, structural models and equations, prediction model for defactored returns, equations, law of reversion. Now here, you see it all. Now here, you see it takes all the writing you can do to keep in the same place. Through the Looking Glass, Lewis Carroll. The potential for reversion where price distributions are heavily tailed. Reversion is possible with any source distribution. Joint distribution, analytical proof of the 75% rule. Discrete counter generalizations, inhomogeneous variances, volatility bursts, numerical illustration, first order serial correlation, analytic proofs, equations, more equations and equations, non-constant distributions, applicability of the result, application to U.S. bond futures, typical 20 business days, summaries looking several days ahead, equations to show probabilities of moves from the current position in the direction of the median occurring within k number of days. Gauss is not the god of reversion. It is better to be roughly right than precisely wrong. J.M. Keynes. Camels, intermediaries, dry river flow, bells show tolls, but not for reversion. Some bells clang. Interstock volatility. The investor does or should consider expected return a desirable thing and variance of return an undesirable thing. Mark Harkowitz, Journal of Finance, Volume 7, November 1st, 1952. Let's see here. Spread return is equal to return on buy minus the return on sell. It's different spreads, typically GM and Ford, General Motors and Ford. Some theoretical explanations. Finish the theory. Primer one, measuring spread volatility. Quantifying reversion opportunities. 49 Vincimus, by endurance we conquer. Family model of Sir E.H. Shackleton, Polar Explorer. Reversion in a stationary random process. Let's see here. Reversion in the direction of the center so that overshoot is allowed and the odds exhibited are pertinent. More equations. More equations. More equations. Charts and graphs. Negative moves from below the medium, negative moves from above the medium, graphs and charts. Movements from quantiles other than the median. Serial correlation. Noble difficulties. Chance favors the prepared mind. Louis Pasteur. Event risks. Will narrowing spreads guarantee profits? Risk of a new risk factor. What impact would have been seen on past performances of a strategy from incorporation of new modeling restrictions? Redemption tension. Regulation fair disclosure. correlation during loss episodes. Trinity troubles. Extinction occurs because selection promotes what is immediately useful, even if the change may be fatal in the long run. T. Dobzhansky, 1958, Evolution Network, Science 1091 through 1098. Yep, 2 decades of outstanding profitability. The returns on many statistical arbitrage managers collapsed to 0 or worse. Decimalization. Statistical arbitrage armed away. Institutional investors enter the market. Algorithms do not have emotions. Then of bad behavior in 2001 to 2003. Let's see. Perspective on 2003. Complex market. Arise black boxes. Felix qui potuit rerun cognoscere causes. Happy is he who can know the cause of things. Virgil. Now, with the black boxes, you can know answers to different questions, urgent questions. How much will I have to pay to buy X thousand shares of XYZ in the next half hour? How much will I have to pay if I wait the remainder of the trading day? How much can I sell of XYZ in 1 hour, keeping the impact to K cents? Dynamic updating, more black boxes, market deflation, the way the market was. Now with the markets, with algorithmic trading, the market is less volatile. To worry about everything is unnerving. It is also counterproductive, for it can result in continual tinkering with the correctly operating system in response to imagined phantoms in the data. Statistical control by monitoring and feedback. Adjustment. Box and Luceno. Yep. Practitioners of statistical arbitrage were out of it beleaguered by 2004. More popcorn models. Extended popcorn models have variable results. Yep. What is the distribution of differences between underlying trend and catastrophic precursor trend? What is the distribution of the magnitude of catastrophic reversions? What is the relationship of the magnitude of catastrophic reversions to the duration of the buildup and the magnitude of the difference between underlying trend and catastrophic precursor trend? What is the set of catastrophes that is economically desirable to capture? What is the cost of a false identification of a catastrophe? Good hunting. Is it over? Question mark. Signing off. New paradigms. All right, so if you guys made it to the end, I know it didn't feel like 30 minutes to me, but if you made it to the end, I want to congratulate you. So my main takeaway from this book was statistical arbitrage follows 2 similar stocks in similar industries. Let's take, for example, the example they took. General Motors and Ford, they have a stock price, or their stock chart moves in very similar directions and trends together. When you see a divergence from that trend, that's a signal to purchase. That's a signal to buy. The trend that moves lower, you want to buy it up, and the trend that moves higher, you want to sell it down back to the median. whatever that happens to be. The tricky part is knowing when to enter that buy signal or when to enter that sell signal. But that's what I got from statistical arbitrage. So I'm assuming what the book is saying, that as more fund managers use statistical arbitrage over the course of 2 decades, returns became 0 to none. So just one more strategy to use if you need to use that strategy, because it's there. All right. So again, this is for me to review these books. This is for you guys to get the gems. I'm already going to be reading the books anyways. So my goal is, I got about 300 something books I need to have finished read in the next year. So if you guys can help me with that goal, just motivate me in the comments, share this video. If you want to see anything different, or you wanted me to read a book, just drop that in the comment section. Subscribe to the channel, and we'll, get your trading journey going and profitable, and you guys make us some money out here. Farewell.